Basically, the fiscal situation is in fact worse this year than what it shows up.
Every Fed tightening cycle of the last 40 years has claimed a major financial casualty.
So we can fix half of the inflation problem just through supply chain healing.
They've had to go on the most aggressive hiking cycle in the modern era.
Good afternoon, everyone. Good to see you. Thanks for joining us today. I'm Jonathan Sanford, Executive Vice President for the Global Business Alliance. GBA is a trade association here in Washington, D.C. We represent about 200 of the most well-known companies around the world. All of these companies were founded abroad and have found success and invested into the United States. GBA companies employ about 12,000 U.S. employees. So these are major U.S. employers. And what's interesting about foreign direct investment is that for every one of these types of jobs, 3 more are created in the U.S. Many of those are at small businesses. So representing an organization that's multi-industry, we've covered just about every corner of the economy, from advanced manufacturing to technology, infrastructure, service sector. We also have our companies employ people in every congressional district across the country. And so it's a great organization with a really interesting mission, which is to ensure that the United States remains the top destination for international investment. About 8 countries, specifically 8 countries, constitute 75% of all foreign direct investment in the United States. And that investment, all those companies are from longtime friends and allies of the U.S. So we started this Economic Advisory Council initiative about 3 years ago. And the purpose is to help showcase the incredible talent that resides within our financial service sectors. We have a lot of companies in that space, and so we wanted to be able to showcase that unique expertise. We also want to provide policymakers with candor and unvarnished assessment of the macroeconomic trends that are going to affect American families and workers. And so in today's rapidly evolving landscape, it's more important than ever that policymakers understand the dynamics that are going to impact American prosperity. And so from geopolitical shifts to technological advancements, the challenges and opportunities facing American workers and policymakers, I think, are diverse and complex. And so it's our hope that by harnessing the expertise of our members, our leaders can better navigate the challenges before our nation. With that, thank you for joining us. Let me introduce you to our special guest today. David Seif is Chief Economist of Developed Markets at Nomura, providing a vast contribution to cutting-edge macroeconomic research. He has 15 years of experience working with prestigious companies and has earned his degrees. He holds a PhD and MA in economics from Harvard and did his undergrad work at MIT. So David, thank you very much for joining us today, and I'll turn it over to you.
Thank you very much, Jonathan. It's wonderful to be here to speak to GBA today. I have titled my presentation, Fed Cuts Finally in Sight. And that's because we really do have a view that after many delays and quite a bit later than markets expected for quite some time, we do think that the first Fed rate cut is finally going to arrive in September at the Fed September meeting. And overall, we really have a pretty benign view of the US economy at this point. We see growth slowing, but only from above trend to at trend, or perhaps slightly below trend, but certainly nothing that would constitute a recession or even anything close to a recession. But at the same time, we see inflation coming down. And so we think that the Fed is actually pretty close to achieving the so-called soft landing that it was aiming for, albeit it seems to be happening in the second half of 2024, arguably a year later than it had been expected to get inflation down. I think the first thing to point out is what's going on the growth side of things, and we really the U.S. economy surprised most economists, and I think it surprised the Fed by not only avoiding a recession in late 2023, but really by growing above trend during that period of time, despite the fact that the Fed had raised rates all the way to 5.375%, so the highest level in many decades. It was consensus among economists that there would be a recession at that point. And if you look at some of the minutes from some of the Fed meetings in 2023, even the Fed's own staff had been expecting a mild recession in the United States. That certainly did not happen. Now, what we have seen, particularly this year, is a slowing of economic growth. We saw GDP growth still very much on the positive side in Q1 of this year, but only at 1.4%, so a little bit below what we think the trend rate of growth is. And we've seen other indicators softening as well, arguably most notably retail sales, where retail sales in the United States has pretty much stopped going up, and in real terms has even come down a bit. But it's still growing or still at close to what its pre-COVID trend was, and we would expect that trend to basically continue. That's been coupled, however, and very positively for the Fed, with real progress on inflation. Less progress, perhaps, than the Fed had hoped, but progress nonetheless, and progress that, as I said, was coupled without a recession. So the Fed, we think, really, starting late last year, articulated a three-step process of disinflation. And I'll go to the next slide right now and just show you a little bit of where inflation has gone in the United States. And I'll draw your attention to this teal line in the middle here, which shows that in late 2023, inflation really had come down quite a bit. It then ticked back up in Q1 of this year, but since then, in the last two inflation readings that we've gotten in the United States, has really resumed its downward trend. So going back to what we think the Fed was really thinking, the Fed, as I said, articulated a three-step disinflation process. It didn't say this in any single meeting, but or in any single speech, but when you look at all of the speeches combined that Powell and some of the other core members of the committee have given, this is what we really think that they were thinking. So the first step in that process was goods disinflation. And actually, not only was there disinflation in goods, but there was actually outright deflation, which is shown by this black line having been below zero. So we had many supply chain issues, which I think we all are very aware of. As those were solved, goods prices actually came down outright. And remember that to get inflation back under control, we're not expecting prices to return to where they were. All the Fed is trying to do is get prices to continue from where they were, but only growing at about a 2% pace. So goods prices falling outright was actually something that was extremely beneficial to the Fed's process of disinflation. And that really occurred in late 2023. And by the end of 2023, after several months of very good inflation readings from the Fed's perspective, the Fed made a very pronounced dovish pivot, which was occurring throughout late 2023, but was most pronounced at the December 2023 meeting. At that meeting, the Fed did two things. The first thing that the Fed did is it declined to raise rates one more time, which was in line with where its SEP, or its so-called dot plot, had implied it would bring rates to by the end of 2023. And the Fed also released a projection for where it expected rates to be in 2024 that said that it would cut 3 times this year. And in his press conference from that December Fed meeting, Powell was extremely dovish. He almost made it seem as though the 3-cut projection was a minimum, so to speak, as in the Fed will certainly cut 3 times in 2024, But if things continue to be as good as they have been, it seemed as though there was upside risk to the number of times that the Fed would cut. We really saw this as the Fed equivalent of the so-called mission accomplished sign that George W. Bush so famously had after the Iraq War, the first phase of the Iraq War. And the results were actually fairly similar in that things did not work out so well following that. After that December meeting, it was clear that goods deflation could not be a major driver anymore. You can only solve your supply chain issues once, and goods prices were never expected to fall indefinitely. So step 2 of the disinflation process was housing. Housing is the biggest component of core inflation, which the Fed looks at so much. In fact, it's roughly 40% of it. And it seemed pretty clear that the Fed expected housing inflation to fall quite significantly. It had already fallen by the end of 2023, but the Fed expected that disinflation to continue. And frankly, there was good reason for the Fed to expect it to continue. Housing inflation has historically been one of the easier things to model. And the reason that it is relatively easy to model is that there are some very good private data sources out there, through Zillow, Apartment List, and CoreLogic among them, that give a very strong indication of where housing is going to go. They release publicly to the public data on new leases that are being signed for rents from their clients, and that really has given a very good indication of where things are going and allows for a relatively simplistic model to be created, which I think many people, including the Fed, have created, and has been remarkably accurate. So I'll move to the next slide and show. Red is what we're calling owner's equivalent rent, which, just to keep things simple, is a very, very good proxy for where all of housing inflation is. And then the teal and gray lines are those private data sources from Zillow and Apartment List. Those are the two up here. They're on slightly different scales, but the bottom line is that you can see just how well the teal and gray lines, the Zillow and Apartment List data, which comes out quite a bit in advance of the OER, how good it has been at forecasting it. It was very good before COVID. It then correctly predicted post-COVID when housing inflation would start to rise. It correctly predicted when housing inflation would stop rising. It then correctly predicted when it would start falling. And then all of a sudden in late 2023, as the model predicted that housing inflation would fall to about 0.2% per month, it really just flatlined at about 0.4% per month and has stayed there ever since. And this is a big deal. 0.2 versus 0.4, if we do the numbers, well, on a yearly basis, so 0.2% per month times 12 months, that's about 2.4% per month, per year, more than we would expect, more than the model would predict. And since this is roughly 40% of core inflation, this 2.4% is about a full percentage point in core inflation that is added because of this one seemingly small model error. But with inflation right now running at roughly 3%, we would argue, and it's reasonable to expect that had this gone down to 0.2% per month, as so many of as we think the Fed predicted, and as frankly we and most others predicted, that inflation would be much closer to 2% right now. It's basically a full percentage point that this has added. So step 2 in the disinflation process did not really work out. We see very few signs that rent inflation is going to fall anytime soon. And so we certainly don't think it's going to fall in a significant way before September. And so the Fed is really going to have to proceed with this additional housing inflation still in there. Now, the good news for the Fed is that going back to this 3-step inflation process, we still think that step 3 is pretty strongly on track, and that is a decline in supercore inflation. So supercore inflation, which the Fed has really focused on very sharply since inflation got out of control, and since especially mid 2022, is services inflation excluding housing, core services inflation excluding housing. And the biggest driver behind supercore inflation tends to be wages. So these are very labor-intensive industries typically that drive supercore inflation. And so the biggest contributor to the cost, and therefore to the prices that are being charged to individuals, and therefore to inflation, is what's happening with wages. And moving on to the next slide, we see three measures of wages in the US economy. It's not that important to go through the differences between them because frankly, all three of them are moving in the same direction. What we're seeing is that by any measure, wage disinflation is occurring. Now, wages are still higher, wage inflation is still higher than it was pre-COVID, but it seems to be moving pretty steadily in the right direction. And this is a trend that we expect to continue. So, actually, before I move on to the next slide, let's talk a little bit about why we think that wages are coming down. This is an interesting question, and frankly, one where I don't think that the consensus quite has it right. So, by and large, the consensus has been that the reason wages are starting to come down is because there has been so much immigration to the United States. Immigrants have come in, there were lots of job vacancies, so the story goes, and immigrants have filled those jobs, allowing for wages to disinflate. And we're pretty skeptical about this explanation. We certainly agree that immigration has been quite high in the United States, and immigration probably has been responsible for helping GDP to grow more than expected. It's been responsible for growing the overall pie, but we don't think it's really bringing down wages all that much. And I think the error here that a lot of people are making is that although it is true that immigrants will come in, take jobs, and help to drive disinflation, on that side of things, there's the other side of the coin, which is that when immigrants come to the United States, they consume as well. And in consuming, they push inflation up. And the net effect of those two things tends to be pretty small. And it means that immigration tends to not be that big of a contributor to inflation. And there's actually good evidence for the idea that immigration has not materially affected inflation. The first thing is that if immigration were to affect inflation in a major way, then we would expect to see differences in the patterns of how wages have evolved based on whether, when you look within the United States, based on whether you're looking at an area where many immigrants have moved versus one where not many immigrants have moved. This is a big country, obviously, and immigrants do not move to the United States and just settle in some uniform fashion. Immigrants tend to be concentrated in a relatively few number of areas. And yet, when you look at wages in the United States and you divide it into areas where there's been a lot of immigration and areas where there haven't been, you see virtually no difference in how the pattern of wages has evolved based on that immigration percentage. More than that, historically, we've observed plenty of examples where there's been massive immigration into a very small area. And really, there's been very little effect in the data on immigration in those areas either. So one good example of this, and you do have to go back quite a ways, but the Mariel boat lift from Cuba in 1980 caused the population of Miami over just a period of a few months to really skyrocket. Most of the Cuban refugees who came, or emigres who came, settled in that one city. And so if this had been a major effect, had a major effect on wages, you would have expected to see wages in Miami grow far less during that period of time than elsewhere. And quite frankly, you see almost no effect. If you look at wages across different cities or different regions in the US in 1980 and in the subsequent year, you just don't see anything from this. So we really discount this as a major cause of disinflation. Again, very positive for GDP growth in the United States, very positive for plenty of things, but not so much of a help on the inflation front. What we think has been the main driver of disinflation in wages instead has been the end of the so-called Great Resignation. Or put another way, it's not so much the net number of jobs that are created that matters, but the gross number of jobs that are created that matters. It is the churn within the labor market that really tends to drive how much wage inflation there is. And just from a stylized example, this actually makes a lot of sense. If you think about, for example, just sort of a very simplistic model of how firms might set wages. You think, well, a CEO says, if it was a normal year, I'll give everybody a 3% wage increase. If it was a good year, I'll give everybody a 4% wage increase. And if it was a kind of bad year, I'll only give everybody a 2% wage increase. But if somebody is voluntarily leaving their job to take another job, they're probably doing it because they expect something like a 10 or a 20 or even more percent wage increase. And this is what tends to really drive the aggregate wage increase in the United States to be quite high. So moving on to the next chart, in red, we see the one of these measures of wage inflation with little bumps around some COVID events. But by and large, you can see it has gone up and then come back down. In gray, we have a measure of the number of people or the percent of people in the labor force who are voluntarily quitting their job every month. Now, some of them are retiring. Some of them are simply leaving the labor force for whatever reason. But once you get beyond a certain point, as this number moves up or as that gray line moves up, it tends to be people who are voluntarily switching jobs because they're quitting their jobs. These are not people who are being laid off or anything like that. And what you see is that this is by far the biggest correlate with where wages have been going. And also what you can notice is that on the right side, the last couple of months, we've actually seen the quits rate fall to below where it was prior to COVID. And we have every reason to expect that this decline that has been occurring over the past couple of years in the quits rate is going to continue, and therefore that wages are going to continue to disinflate as well. This is also shown in some of the surveys that CEOs have filled out. So if we look at surveys from the Conference Board, we have a couple of questions here that the Conference Board asked CEOs that says, in the red line, how many of you anticipate a lot of trouble hiring everybody you need over the next 12 months? And the gray line surveys the results of how many of you plan on raising wages over the next year by more than 5%. And what you can see is that these had major spikes in the period immediately following COVID, but now they're really pretty much back to pre-COVID levels. So we think that we're actually getting quite close to wages getting back to an inflationary situation where they're much closer to where they were pre-COVID, and something that is consistent with super core inflation falling back down to 2%. It's why we think the Fed is going to cut in September, and frankly is starting to play out in the pretty soft inflation print that we got, reading that we got for May that came out just about 2 weeks ago, where not only was inflation below target, but the areas, or below expectations, but the areas in which inflation really missed to the downside, so something that's very helpful to the Fed, was in super core inflation, which actually was negative on an outright basis for the month of May. Now, I think it's only fair to look at what are downside risks to our pretty benign view on economic growth, because, quite frankly, although we see a slowdown occurring that is only going from above trend to very close to at trend, there are those who would point out, and it's not unfair to say, that Well, if you're going to slow to a recession from above trend, to get from point A to point B, you would first need to slow down to at trend and then continue to slow down beyond that. And I think there is at least some evidence of some stress in the economy. If we look, for example, at credit stress rates or credit delinquency rates, we do see that credit delinquency rates are, especially new 30-day delinquent balances, are the highest they've been in well over a decade when it comes to credit cards. So we do recognize this as a risk, but our thought is that the labor market still is quite strong in the United States. Yes, people are not quitting their jobs in the same way they were, but we still have an unemployment rate that's only at 4%, a historically very low rate. We're still seeing job creation most months that is above trend. We think that the steady state rate for the economy, even with the amount of immigration we're seeing, is no more than about 175 to 200,000 jobs per month. And with very few exceptions over the past year, we've consistently seen numbers of job creation that are above that. So that leads us to think that what we're looking at here is a relatively small number of people who have probably lived beyond their means during COVID. And once the COVID aid got cut off, or once the COVID aid ended, they did not really reduce their spending so that they could live on their salaries, and have run up credit card balances. But I think the bottom line here is that it's very hard for credit to fall off a cliff, or credit payment frequency to fall off a cliff, when we see very strong employment. So as long as we continue to see a robust labor market where virtually everybody who wants to have a job is able to have a job, we think that this is going to be quite steady. So it's something that is pretty low on our list of worries right now, although it is something that we will continue to watch out for. Let me pivot a little bit now and talk about our views on the U.S. presidential election. Bottom line is, we see this as an extremely close election. We've had a lot of debates internally about whether Biden or Trump has an advantage here. And we really do settle on Trump having a very, very slight advantage here, or slightly better than 50% chance of winning, but really not much more than that. We think this is extremely open, what could happen here. So first, I'll just put up a chart of the horse race a little bit. And as you can see here, this is our, on the left side, this is a sort of listing of states that we think are ordered based on likelihood of Biden winning on the left and likelihood of Trump winning on the right. And right now, it looks to us, based on polling, that Trump is in the lead, but that if Biden were to take the lead and ultimately win in Wisconsin, Michigan, and Pennsylvania, where we see Trump up by 1%, 1%, and 2.2% respectively, that would be enough for Biden to win. It would be a squeaker, but he would get it. It's hard to see with the slide here, but Wisconsin, Michigan, and Pennsylvania, and then assuming that both Maine and Nebraska split off one electoral vote, would leave Biden with 270 electoral votes exactly, and Trump with 268. It is very close, and Biden really only needs a couple of percentage points movement in aggregate in order to take Wisconsin, Michigan, and Pennsylvania, and we think ultimately win the election. Actually, let me have that slide blown back up again so that it's big again. Yeah, thanks. The other thing that we have focused on, and this we haven't seen many people write about too much, but we think that Trump's structural advantage in the Electoral College has significantly declined compared to both 2020 and 2016. So what do I mean by that? It is really to say, how much can Trump lose the popular vote and still win the Electoral College? In 2016, based on the results, Trump could have lost the popular vote by 3%, or maybe I'll phrase it the other way. Hillary Clinton needed to win the popular vote by more than 3% in order to win the presidency. and Hillary Clinton won the popular vote by 2.2%, and therefore she lost the election. Now, from 2016 to 2020, Trump's structural advantage appears to have actually increased. Trump needed to win. Biden needed to win the popular vote by 4 percentage points in 2020. He ended up winning by 4.5 percentage points, and therefore he, quite narrowly won the Electoral College. Now, based on polling today, between the gap that shows the gap between the national average, where we think Trump is up by 1, and the tipping point state of Pennsylvania, where we think Trump is up by 2.2, we see a structural advantage for Trump of only 1.2%. So what does that mean? It means that we think that Biden would only need to win the popular vote by 1.3 percentage points in order to squeak through with an electoral college victory. Put another way, Biden could underperform how he did in 2020 by about 3 percentage points, more than 3 percentage points in the popular vote, and still win. And he could even underperform how Hillary Clinton did by about a full percentage point and still win the election. The reason for this, we think, is that, although, Trump is certainly polling better than he ever has on a national average, where it appears to us that where Trump has made inroads into Biden's base, it has tended to be among voters who are not living in these key swing states. Conversely, Biden has made much more limited gains among previous Trump voters, but where he has, it has tended to be in suburban women, and plenty of women live in the suburbs of Philadelphia, of Detroit, of Milwaukee, i.e., in these key swing states. And so that differential effect actually has net helped Biden. Now, again, as I said, Trump in national polls is polling better than he ever did in 2016 or 2020. So decreasing the structural advantage that he has won't do anything for Biden if Trump continues to win in the national average. But it does mean that even though Biden is underperforming by close to about 5.5 percentage points in national polls, where he ended up winning the popular vote in 2020, we don't think he needs to close that gap fully at all. In fact, he probably only needs to close less than half of that gap to win. Now, the next thing is the Senate race. And here, we think it's clear that the Senate race favors Republicans. There are 8 seats at risk for the Democrats, and frankly, 0 seats at serious risk for the Republicans. And one of those 8 seats is West Virginia, where it seems almost a foregone conclusion that the Republicans will pick up retiring Senator Manchin's seat. That said, assuming Biden does win the presidency, the Democrats would keep control of the Senate, assuming it's a 50-50 split. It does appear right now that the Democrats are in the lead in all 7 of these other swing Senate districts, Senate states: Montana, Wisconsin, Arizona, Ohio, Michigan, Pennsylvania, and Nevada. In all of those states, some of which are pretty clearly red states, and others being purple states, the Democratic Senate candidate is both winning and outperforming where Biden is polling in those states. And so, although it's not our base case by any means, we do think that it is a reasonable chance that if Biden wins, Democrats do have unified control of the government, and we wouldn't discount that possibility. I want to make sure to leave plenty of time for questions, but I want to just talk about where we think the implications are for government policy based on the election result. I think there really are 2 different dimensions that we have to look at. The first is, of course, who wins the presidency. And the second is much more whether there's a united or divided government, irrespective of whether it is united under the Republicans or united under the Democrats. So when it comes to tariffs, which I think is perhaps the thing that the market, at least that financial markets, are most fearful of at this point, here it's really just about who wins the presidency. The president has nearly unilateral power to impose tariffs on most countries. Canada and Mexico, a few others, are an exception to this unilateral power. But in general, when Trump talks about putting 10% tariffs on pretty much all countries, we pretty much take him at his word that this is achievable. It seems pretty clear that based on the second 2 years of his term, he is able to appoint the right people, be it Lighthizer or somebody else, to effect these tariffs. And we think he will actually do it if he does. And that is a very stark contrast from Biden. Biden may do the occasional targeted tariff on Chinese EVs or solar panels, et cetera. But we see largely no change in tariffs under Biden, but a pretty big increase in tariffs under Trump. Now, when it comes to the fiscal side of things, a lot of what we think really matters, though, is not so much which party is in control, but whether any party has unified control of the government. And a lot of this is because of what we see as the fate of the expiring provisions of the Tax Cuts and Jobs Act, or the 2017 Trump tax cuts, many of which expire at the end of 2025. So this next slide here just shows a list of provisions that are set to expire from the Trump tax cuts. I certainly won't go through all of them, but the bottom line is that over the next several years, we see this as over $2 trillion that would likely that is likely set to expire. And frankly, we think that if the Republicans have unified control of the government, at a first approximation, they will extend all of these tax cuts. That seems like a pretty safe assumption. They were the Trump tax cuts to begin with. The thing that's interesting, though, is that if the Democrats are in control, they will probably extend the majority of these tax cuts as well. And we've seen this sort of pattern when Democratic administrations are in power and looking at expiring tax cuts from previous Republican administrations. Typically, what has been done is that the top tax rates, the magic number has become on people earning more than $400,000 a year, but whatever it is, the top tax rates tend to get raised back up, but the bulk of the tax cuts tend to remain in place. And so we think that even if there's a unified Democratic administration, Democratic government, most of the tax cuts are going to be in place. The big risk to us seems to be that there would be some sort of a fiscal cliff type event, either due to the expiring tax cuts or due to the debt ceiling or some other thing that causes there to be a major increase in revenue collected or decrease in spending from the government. With the US government running such large deficits, it might actually be good for the long-run fiscal situation if the US were to narrow its deficit, but certainly in the short run, it would not be good to see a very sudden end to the Trump tax cuts, or at least the expiring ones, at the end of 2025. This is something that could easily be 2.5% of GDP, and that would cut the deficit roughly in half, we think. That would almost certainly cause a big hit to growth and actually risk sending the U.S. into an outright recession in 2026 or soon thereafter. So we think these risks would be much lower under either party's unified government. And so from the prospect of a fiscal policy, we see unified versus divided as the more important divide from a macro perspective than who actually wins the presidency. So let me pause there. I've spoken for a while. I would be very happy to take any questions at this point.
Very good, David. Thank you very much for that presentation. Very interesting and covered a lot of ground pretty quickly. So certainly would like to take questions from the audience. If you're watching today, feel free to utilize that chat function within YouTube to ask your questions. We'll pull those up. While we have questions come in, I did have one as you were presenting. I was curious if you could talk a little bit about, the current projections indicating a strong job gains as well as low unemployment. Do you believe that that's sustainable and how long of a runway do we think that environment will last, especially given kind of where we are with inflationary pressures?
Sure. Well, I think we like many economists and the Fed itself have been surprised by the resilience of the U.S. economy. Although, a few commentators did certainly get it quite right. We think that I guess the bottom line would be, if higher rates over the past 2 years have not caused there to be a big breakdown so far, it seems unlikely that they're going to at this point, especially with what we think is going to be the beginning of an easing cycle less than 3 months from now. So we think that this is something that could continue indefinitely unless there's some sort of a shock to the US economy that we don't foresee. But we think that at this point, this is something that is likely to continue for the foreseeable future. And it's, I would say it's precisely because we see the inflationary pressures abating that we think that the Fed will be able to start loosening policy. And given that the Fed is likely to start loosening policy, that will remove what was seen as, this tight Fed policy, what was seen as the biggest risk to the continued economic expansion.
Very good. Thanks, David. Again, if you have questions, you can ask those in the chat function. Appreciate it. I also wanted to mention that on our website, we've got a full rundown of what international companies are doing in the United States, including on a state-by-state basis. So if you navigate over to globalbusiness.org, you will see that site is also on our screen now. But I encourage you to check it out, see what is happening, what companies are doing in your state. David, I'm curious if you could talk a little bit about, you mentioned core inflation, which is really kind of being driven by services and the wages there. I think if I heard you correctly, maybe you could talk a little bit about where you see that landing and kind of the time horizon for that to come under back to maybe norms.
Sure. Well, the Fed's target for core inflation, and they look at core PCE. There are a number of measures out there. The Fed's target or the Fed's forecast for where it will be this year, according to numbers that it just released a couple of weeks ago, is 2.8% for the year. We actually see some downside risk to that. The Fed's target, of course, is 2, so 2.8 is a little bit higher than it would like. We don't think it's going to come that far below that, but we think, especially with the soft inflation print that we just got 2 weeks ago, ironically just a few hours before the Fed released those projections, that it's going to be more in the range of 2.6 to 2.7, and then that may seem small, but it's actually, when we think about the distance from 2.6 versus 2.8 is reducing that distance away from the Fed's target by 25%. So I think the Fed will see that as pretty meaningful. And we would expect inflation to then fall into the low 2s by 2025 and to remain there for as far as our forecast horizon goes. We don't see any major risk of a reacceleration or anything like that at this point.
Gotcha. Maybe broadening the conversation outside of the United States a little bit. You talked a little bit about the geopolitical climate, but I'm curious, the trade tensions, the economic uncertainties globally. How do you think that factors into the Fed's decision making?
Yeah, so the Fed is unlikely to pre-react, so to speak, react in advance to any sort of policy. It's not their job to do it, and frankly would be outside their mandate. That said, we think that tariffs are certainly all else equal an inflationary force. So if Trump does win the election and does indeed put these tariffs in place, we think that the Fed would be likely to be a little bit more hawkish than it otherwise would be. Now, you have to think about the timing of this. Trump, if he wins, will not become president until January. It would probably be a couple of months before he could get the tariffs in place, and then at least a couple of months beyond that before there would be much of a much of a sort of impact on the inflation data. And it really would have to be evident in the data before the Fed would be likely to react to it. So we're really talking about something that would probably not start to affect Fed policy until later on in 2025. So we're pretty far from that at this point. But yes, we do certainly think that our sort of base case, unconditional on who wins the presidency, is that the Fed is going to start cutting rates in September of this year and then continue to cut rates into the first quarter of 2026 at a fairly steady pace. But I think if Trump wins and does put these tariffs in place, there would certainly be risks that the back end of those rate cuts would not happen, and the Fed would stop cutting rates when the Fed funds rate is still higher than we forecast it will ultimately get to.
Earlier this week, the Select USA Investment Summit took place out at National Harbor. Brought about 5,000 would-be investors from around the world to the United States. Secretary Raimondo, as well as a number of her colleagues from the president's cabinet, spoke as part of that, making the case for investing in the United States. As you kind of survey the macroeconomic trends around the world, how do you see the United States faring relative to other advanced economies?
Yeah, the United States has done much better than other advanced economies by and large, and so it has really been the standout. Europe, most of the euro area, and the UK last year did experience mild recessions. Perhaps that was due to things related to Ukraine and that affected them much more than it affected the United States. But whatever the reason, it was the United States and pretty much the United States alone, where growth was above trend last year, and so it has continued to perform quite a bit better. And if you look at both our expectations for growth in the United States versus other developed countries, and frankly the consensus estimates as well, it is for U.S. growth to be considerably better. And then, beyond just where the sort of raw growth number comes in, when you look at some of the industries that are on the cutting edge of where investment is taking place, those tend to be heavily concentrated within the United States as well. So, certainly it seems like that the United States, which it has been for quite some time, continues to be, and maybe even more so, one of the best places to make investments.
I see a question came in from one of our viewers, Ethan. Thanks for the question. He's asking about housing and rent prices and kind of your vision for where they're headed. Do you think that they'll continue to escalate, decrease, or flatten in the future?
Yeah, so first thing is that it's important to really separate house prices with rent from rent. Because when we talk about housing inflation, when the Fed talks about housing inflation, I should be clear, it is looking at rent prices. And when it thinks about, even for people who own their houses, what the Fed is trying to do is say, if you were to be renting the house from yourself, you the renter renting it from you the owner, what would the market price for that rent be, right? And that does not always move at all in the same way that housing prices move. So we think that it's really focusing in on rent that is the most important thing to the Fed by far here. And we see it remaining fairly elevated, which, as I said, was a surprise to us, was a surprise to clearly much of the Fed. But we don't see much moderation coming down the pike, certainly this year, in that. Now, it could surprise us to the downside in the same way it surprised us to the upside. But we think that continuing to inflation continuing to come in at about 0.4% a month, which is almost 5% a year, well above the Fed's 2% target for overall inflation, is something that remains a real risk. Might moderate a little bit as we go forward, but we think it's going to remain fairly sticky there for the next few months.
Maybe kind of a corollary to that, the consumer spending trends. You mentioned the stressed credit. Do you think that will alleviate itself over time, and what does that horizon look like?
Yeah, I think that the key thing is does it keep rising? Because it's not really at a level where it's that stressful to the economy. And I think it would be fair to say that not all delinquencies are created equal, right? If someone is delinquent on paying a bill of any kind and they don't have a job, there's a pretty good bet they're defaulting on that entire thing, and that you're not going to get payments on that anytime soon. And the more people are losing their jobs, therefore, the more these delinquencies are likely to rise. When you see delinquencies rising, but there's full employment in the economy, it's much more indicative, and it's a rare thing, but it's much more indicative of people who have simply been spending beyond their means and have run up their credit card. It's a big difference if you're spending $80,000 a year and your income is zero, versus if you're spending $80,000 a year and your income is $65,000 a year, right? If you're in the latter category, you need to cut your spending. You need to figure out what to do. Maybe you do default on some things, but by and large, this is something that does not then cascade through the economy and become worse and worse over time. And we really think that, given that the labor market is so strong, that we see, basically no signs of stress. Yeah, that it's not overheating anymore, but it's not stressed either, that this is a relatively benign situation when it comes to delinquencies. But of course, we do flag this as a risk. Bottom line, new delinquencies are the highest they've been in well over a decade. And so, we don't want to ignore that just because it doesn't fit cleanly with our story, so to speak.
Last question I have for you today. I really appreciate your time today, David. Looking at the kind of geopolitical landscape, you mentioned at the conclusion of your comments, the U.S. perspective on the upcoming elections, but curious what you're watching in terms of some of the other major democracies around the world, and what the implications of those elections might be. We have upcoming elections in Europe with France. We saw in England. We saw India go to the polls as well. Welcome your thoughts.
Yeah, absolutely. Well, the French election, which really came out of the blue, that is I'll use an American term here. That is a real knuckleball, as in we have no idea where it's going to go. And I think it is very hard to predict because of the extremely complex nature of the sort of two-round French polling system. It's an interesting thing is that when Macron, out of the blue and very, very shockingly, called this legislative election, the market reacted very negatively because it feared that the far right might gain power. And I'm of course not making any political statement about the French political system, but what we have seen from Marine Le Pen's I won't even try to say the French RN party is that it has really moderated its message quite a bit, both over the past 5 years or so, but also over the past few weeks. It appears to be trying to take a page from Giorgia Meloni, who is labeled far right and is the prime minister of Italy, in wanting to work within EU fiscal rules and be really focus on good governance. We saw two elections where in Italy where far right parties gained a good chunk of power. And in the first one, it was sort of a disaster for the markets. And in the second one, with current Prime Minister Meloni, it has been a very benign outcome for markets. And Le Pen is clearly trying to orchestrate that. What actually seems more worrisome right now is that this somewhat amorphous coalition of far left parties could win in France. And even though they are decidedly second in the polls right now, as I said, because of the complex nature of the two-round French system, it is actually quite conceivable that the far left could win, and that the far left, and that would actually be viewed quite negatively by markets. There is no single unifying figure on the far left in the way that Le Pen is on the right. But Mélenchon, who is the sort of leader of the biggest of those far left parties, has pretty openly thumbed his nose at EU fiscal rules. And it has the making of something that could really scare markets quite a bit if he were to gain power. So we're certainly going to be watching that very closely. In the UK, the election on Thursday, a week from today, seems as though it is almost a foregone conclusion. It appears that Keir Starmer is not only going to win, but win so big that he will become prime minister with one of the largest majorities that we have seen in the House of Commons, perhaps ever. We view this quite benignly. Usually in an election, the left wing winning is seen as a negative for markets, and the right wing winning is seen as a positive. Again, not a political statement. That's just empirically how markets react. But Keir Starmer is much more moderate than his predecessor as head of the Labour Party, Jeremy Corbyn. Here is somebody who has put out a very reasonable fiscal plan, and could also perhaps lead the UK to start to turn back towards the EU, not necessarily to rejoin the EU anytime soon, but to seek out the reestablishment of closer ties with the EU. And frankly, that is a bigger deal to the UK economy than other things like, is there going to be a small tax here or a small tax cut there? Or is the Bank of England going to cut next month or in 3 months or anything like that? The EU and the UK are physically very close, extremely close trading partners. And I think it would be very good for the British economy, and therefore for UK markets, perhaps, if there's any sort of a push towards bringing the UK back into a closer relationship with the EU.
David Seif, Chief Economist for Developed Markets from Nomura. Really appreciate your time today. Thank you very much for sharing your perspective. If anyone has additional questions that they would like to ask, please feel free to reach out to me. My contact information is on our website at globalbusiness.org. With that, we'll go ahead and conclude today's session and look forward to reconvening in a few months. Thanks again, David.
My pleasure.